Well, sentiment was somewhat firmer across financial markets last week amid a somewhat softer and more conciliatory stance out of the United States on the whole trade and tariff saga, although it must be said that concrete developments on that front are still somewhat lacking. Nevertheless, we did still see a solid weekly gain on Wall Street, while the dollar and treasuries found some demand as well. A monster week now lies ahead for financial markets, including what will be the busiest week of Q1 earnings season, plus a deluge of top-tier economic data releases, elections in Canada and Australia, a policy decision out of the BOJ, and last but by no means least, the US Treasury giving us their quarterly refunding announcement. Plenty for us to discuss on the trade-off this week, so without further ado, let's crack on with the show. So it's a busy old week for financial markets last week. Looks set to be another busy week this week as well. Joining me, as always, to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forexo Live and Forex Analytics, fresh from what I imagine wasn't the happiest trip to the seaside over the weekend.
No, I had a very happy trip to the seaside, thank you very much, mate. And then I went to the football and it all went all wrong from there. So, swings and roundabouts. The sun was out and the beers were flowing, and that's the most important thing.
Well, indeed. And as a West Ham fan, I suppose you should be used to disappointment by now. In any case, the sun is definitely shining here in the UK and seems to be shining on the financial markets as well. The S&P 500, as I speak, working on what will be a fifth straight daily gain if we can get there.
Yeah, stocks back to being bullish again. And you say lots of earnings coming up this week as well. They haven't been too bad so far. And as we like to say, you can't keep a good stock market down.
Well, indeed. So as it seems at the moment. In any case, plenty for us to discuss this week. So let's crack on with Topical Thunder. So where to begin? Well, there's only one place to begin today and probably for the next 3.5 years, and that is on the issue of trade, tariffs, and the ongoing saga in the United States. And what I guess is interesting is that there seems to have been a bit of a shift in tone out of the Trump administration last week, not only in terms of what has been said, which we'll get onto momentarily, but also who has been saying it. We've heard a lot more from the Treasury Secretary Scott Bessent, a lot less from the Commerce Secretary Howard Lutnick, and nothing at all from the uber hawkish trade advisor Peter Navarro, who I think has been locked in a cupboard in Washington, D.C. somewhere. And for the sake of everyone, let's hope he stays in that cupboard. In any case, in terms of what has been said, a lot of it has come via sort of sources reports and various other reporting that's been taking place. Concrete developments remain lacking, but overall the tone has been a little bit more conciliatory and a little bit softer out of the Oval Office than it has been certainly than it was in the first half of the month. We've heard the Treasury Secretary saying that he believes the current situation between the US and China is unsustainable. We've had various reporting that a deal between the United States and India could be close, and perhaps more importantly than that, the idea that that deal could prove to be a template for other such agreements with countries in the Asia-Pacific region. We also had the Wall Street Journal reporting that the US might be prepared to make what they were calling unilateral cuts to the tariffs that have been imposed on China, while Reuters were also talking about those potential China tariff reductions, but saying that they would only come in conjunction with moves that China make and wouldn't come unilaterally. Now, of course, a lot of this continues to be denied by both sides. I guess the most interesting sort of oddity around all of this is we've heard Trump saying pretty much every day that he's been speaking to China and that he's spoken to President Xi, and then pretty much every day China are coming out and saying, well, no, there's actually no talks taking place. So maybe the Donald is talking to himself on that front, but on balance and on average, the news flow has been decidedly more positive on the trade front than it has been over the couple of weeks that came before in the run-up to and after Liberation Day, of course. And add into the mix as well, Trump saying that he has and had no intention of firing Fed Chair Jerome Powell. And again, you see a few risks reduced on that side as well, although I would stress that given the Fed are almost certain to hold rates steady next Wednesday, Powell's head could be on the chopping block rather sooner than many would be hoping for. In any case, the only negative development over the last week or so came in an interview that Trump gave to Time magazine on Friday, where he said that even tariffs as high as 50% on imports in a year's time would be, in his mind, a total victory for the United States. I think his definition of that is very different to most others. But I guess the fundamental message here remains that we have a hell of a lot of noise and very little in the way of signal or concrete development. So while the market has got a little bit overexcitable, 4 straight daily gains in the S&P, up 4.5% on the week, personally, I find it a little bit hard to buy into that degree of optimism.
Yeah, I think the markets, it certainly seemed to me towards the latter part of last week, maybe suffering a bit of headline fatigue. As you say, it's okay, getting all these headlines day in, day out, day in, day out. But the market is really looking for the end game now. Are we going to get trade deals done, tariffs reduced? Is it going to be signed, sealed and delivered, rubber stamped? We even had Fed's cash and carry coming out as well, saying that the amount of communication from the administration is just making things a complete mess. So even the Fed heads are moaning about.
Rich, isn't it, from him?
Yeah, well, exactly. He only said that 15 times last week as well. So, but yeah, it's markets are funny things. If you keep hammering it with the same old headlines, at some point it's going to stop trading it until we actually get something, like you say, concrete coming out. And until such time as we do, then we're going to be trading around this mess. But the effects in markets are becoming less and less at the moment.
Yes, absolutely. I did throw out on the internet a few weeks ago, a bit tongue-in-cheek, saying that the Trump strategy is that the beatings will continue until morale improves. And, well, not only did that seem to be the strategy, but it also seems that morale has subsequently improved as they've beaten us down with headlines day after day. The last thing I do just want to mention on this is something that the Treasury Secretary Scott Bessent said over the weekend, and I do take issue with this. He was on various television channels in the United States over the weekend on all the ABC and all the rest of the Sunday news shows. And he said he was basically complaining about the media, saying that 10 days ago, there were all headlines galore saying that April was the worst for the equity market since the Great Depression back in the 30s. And he was wondering why no one was now writing headlines saying the equity market has what he was calling the biggest bounce back ever. Well, the reason for that, Mr. Bessent, is the same as if I went round and burnt your house down. If I did that completely unprovoked, then rebuilt the bottom floor and went, why am I not getting any credit? You'd think, what the hell's this guy on about? That's exactly the analogy I would use to describe what the Trump administration have done with the economy and with financial markets. Anyway, while I get off my soapbox and go and calm down, I'll leave you, Ryan, to discuss the Bank of Japan this week.
Yeah, definitely. Yeah, you're well on one today, aren't you, mate? But
tired, haven't you? I've had half an hour to prepare.
Right, well, anyway, moving on. Yeah, I'm going to talk about the BOJ and the potential for perhaps a surprise hike coming through. This week's BOJ meeting is maybe one of those little surprise moments for the bank. As much as they like to have a sort of running standard script between monetary policy meetings and changes, they're not averse to pulling out the odd small surprise now and again, and particularly against market expectations. As usual for the Bank of Japan, they can't seem to get a break and just conduct monetary policy without any outside influences to think about. And obviously this trade tariff saga is a big one that's going to have them acting very cautious, as they have been already. Now, I would say that if we didn't have any sort of geopolitical input from the US, and on top of all the current crop of good data we've had recently out of Japan, including that bumper set of Tokyo CPI numbers last week, I'd say we were probably 90% certain, maybe more, of getting a hike at this meeting this week, instead of the likely pause. But we do have all this geopolitical stuff going on, and I think the decision is going to be more of a coin flip. Now, there's certainly enough economic data evidence to at least put them close to a hike. We've had the spring Rengo wage negotiations coming in around 5.3, 5.4%, which is yet another solid round of yearly pay rises and hikes coming into the new financial year. That's raising the prospects of real wages turning higher as well and rising further, as Ueda expects, and that's one of his conditions for seeing further hikes. Then we have the Japanese government. They're seemingly busting a gut to get deals done with the US in any way, shape or form they can. And lastly, at the G7 meeting, they maintain the FX statement. It's very important for Japan that they keep those lines the same. And we had Treasury Secretary Besant also commenting on those, saying the US wouldn't target a level for the yen. So it seems they're off the hook for that too. So there's plenty of reasons, I think, why the Bank of Japan might decide to look through all this geopolitical noise and maybe look towards a hike. And that's why I think, personally, a hike is maybe a bit more of a possibility than the market expects. And that's something to watch for if you're trading the yen. I'm looking at dollar yen for this one. And we held on the dip down to the 61.8 fib of the big move that we've had recently. That's down around that 141 high 139 area. Then we saw a bounce from there. It's taken us back to sort of towards the 144 level. And for the meeting itself, depending on what the dollar's doing, I'll be watching for maybe a surprise hike to give this pair a dip, maybe back down to that fib area, the 140 area. That might be an interesting move to look for a bit of a fade there. So that's a bit of a setup I'm looking at for this week at least.
Well, I'll give you my thoughts on the BOJ momentarily, but the most important question of them all to gauge how key a meeting this is likely to be. Ryan, are you going to be setting an early alarm?
I might do, I might do. I'm still a little bit, I'm in an argument about it, but I might get up for this one.
Oh, there you go. The bat signal has gone out. Sorry?
Will you be there, though?
Oh, absolutely not. I'll be fast to kip. There we go. The bat signal has gone out. Mr. Littlestone is going to be awake. They're going to be all worried now in Tokyo that they're going to surprise the markets. On a slightly more serious note, the one thing I would mention in terms of the BOJ, unless I've completely missed them, which is very possible given the amount of news flow we've had recently, I haven't seen any sources reports in the run-up to this meeting. I think there was one a while ago talking about how they're unsure how tariffs will impact their growth outlook. But that's the one thing that just makes me think maybe they won't pull the trigger on a rate hike because they haven't really guided the market towards that outcome. And given the degree of volatility and uncertainty that is already out there, would policymakers want to throw a rate hike on top of that? I don't know. But if they are going to do so, then well, we're recording this 2:30 in the afternoon London time on Monday afternoon. So they've got, 2.5 days to get some friendly journalists at the Nikkei to write up a few pieces and tee up market expectations a little bit more. But unless and until that happens, I think they'll signal further tightening, but actually delivering it, probably going to wait for another day.
Yeah, it's a good point on the sources. We are in the zone, so yeah, likely Harry gave the kiss of death the other day when he mentioned something and it happened 5 minutes later, then we should be on watch for this one as well.
Yeah, that does seem to be the way. Don't worry, I've got my phone here. I'll be glued to that to see if anything comes in while we're talking. Before that does or potentially happen, let's have a chat about some of the other data that we've got coming out this week. So we do, of course, have the non-farm payrolls data coming out of the United States, with this Friday being the first Friday of May. And as is always the case, this is the most important jobs report ever, well, at least since the last one and at least until the next one. In terms of expectations for the April figures, we are expecting headline non-farm payrolls to print 130,000, a fairly chunky slowdown from the above consensus 228,000 that we saw in the month of March, although that would be a print that is in line, as near as makes no difference anyway, with the break-even pace of jobs growth required for growth in non-farm payrolls to keep pace with the expanding size of the labour force. As always, the range of estimates for that non-farm payrolls number is frankly ridiculously wide, between 50,000 to the downside and 170,000 to the upside. And again, as always, you'll have to wait until midday on Friday for my personal payrolls guess. In terms of the other parts of that jobs report, average hourly earnings, they are seen holding steady at 0.3% on a month-on-month basis. That would see the annual pace of earnings growth tick a little bit higher to 3.9 from a prior 3.8%, but that's really not going to be of any concern, particularly to policymakers. The labour market clearly not a source of intense upward inflationary pressure at this moment in time. And then in terms of the household survey, unemployment, that's seen holding steady at 4.2%, and that would be on an unchanged participation rate of 62.5%. Just a couple of words on that. The uptick in unemployment that we saw in March, I think we probably discussed it at the time, that was a good rise in unemployment because it came as participation rose, so more people seeking work as opposed to an increase in layoffs. The other thing is that the 4.2% we saw in March was a low 4.2%. If you look at the unrounded data, it was actually 4.152%. And I know you're shaking your head at me there. The reason I mention this is because it doesn't need a lot to change in the labour market for that to then round down to 4.1%, and every man and his dog going to be running around going, oh, great, unemployment's fallen, when actually the realistic shift is going to be very, very minimal indeed. So it might be slightly nerdy, but there is value in there somewhere, I'm sure, or at least that's what I'm telling myself. In terms of the risks around the headline print, we could see some upside in certain sectors such as construction, given the decent weather that we had last month. But again, the outlook is very, very cloudy. We'll be looking for whether we saw some preemptive layoffs as a result of all of the tariffs, particularly focus on logistics and transportation on that front, and also leisure and hospitality as a gauge of whether consumers are starting to tighten their belts as a result of the increase in uncertainty. Of course, bear in mind that the jobs report gives us an idea of how labour market conditions were in the week containing the 12th of the month. So that is a survey period that came, well, pretty much during and slightly after Trump pulling his U-turn on reciprocal tariffs. So I think that context is important. In terms of implications for the Fed, I don't think there's many. They're not going to overreact to one data point, whether it be hot or whether it be soft. We did hear from the Fed's Hammack last week saying that they could move in June if there is what she was calling clear and convincing data that necessitated they do so. One non-farm payrolls number is neither clear nor convincing. And again, for financial markets, I'm going to really repeat what I said in previewing the March report this time last month, in that there are asymmetric risks around the data. If it all comes in on balance better than expected, it's not going to provide much relief you would expect. It's a case of slowdown delayed rather than slowdown averted, as we all know the uncertainty and the hit from tariffs that is now baked in. And if it's if it's a softer than expected report on balance, then that's just going to crystallize everyone's recession and growth worries, which will then likely be exacerbated as we move through the remainder of Q2. So that's how I'm seeing the jobs report. Ryan, I'm sure you're now going to tell me your guess for the payrolls print anyway.
Oh, so you want a number out of me, but you refuse to give one.
You'd love to give it to us early, don't you? So
I'm gonna give you a guess. I'm going to say 145. There we go. But
really sticking your neck on the line with that one.
I'm gonna caveat that by saying if we finally get the government numbers dropping in, it's probably going to be minus 20. It's my competition. I can guess as many times as I like.
Oh, don't know it's your competition. We can't go down that route again.
But it seems to me that the expectations are quite tight. 120k between top and bottom. I think that's a fairly tight one at the moment. And it is edging towards the low side. So as you say, the market, as we've been saying on these shows, the market is looking for bad news to come at some point. So it's not going to get its expectations too far on the bullish side. One thing to note this week, we usually get both ISM reports coming out ahead of the numbers. And the employment components of those can often be used just to do some final tinkering with NFP expectations. But the ISM services number actually comes out next Monday while we're on bank holiday. So we're not going to get that input for the numbers this week. Not that it's probably going to make any difference anyway, but numbers have to stand up on their own. But yeah, good numbers. We probably see, we see the moves faded. We are, as you mentioned at the top of the show, seeing a bit more positivity or less negativity at the moment. So if we do get good news and the market hasn't changed its mood during the week, then maybe we're going to see that continuing rather than getting lumped on and sold as soon as it pops out, like we've seen with good data recently. So yeah, it's one of these data points. Know what the market's doing going in on Friday and take your cues from that.
Yes, absolutely. And for anyone who is happening to watch this later in the week, the market is likely to be doing a very different thing on Friday morning going into the jobs numbers than it is right now on Monday afternoon as we all start the new trading week. So, context absolutely key on that one. But it's not just the jobs report that we have up this week. It's a busy week of data besides that as well.
Yeah, tons and tons of data. I'm not going to go through it all, but there's too much. We'll be here till next week. But there is a big old data slate outside of the NFP numbers. Europe's going to be very busy as well this week. We've got all the flash Eurozone CPI numbers coming through from various countries. We've got flash Q1 GDP numbers as well. So that makes it a very, very big week for the ECB. We've got some governing council members who will be looking to run more victory laps if inflation continues to come lower. But they've also been, pumping that the economy has been resilient and apparently improving. I don't know where they're seeing that happen, but that's what they say.
Yeah, are they looking at a different economy, I think?
They must be, yeah. So that leaves two banana skins for them to face this week anyway. Now, with expectations rising, the market pretty much fully pricing a June cut and further cuts following that, one would suggest that if we get lower inflation and better GDP numbers, then that perhaps would limit the need for further cuts to come, because we do know that the ECB is one of the most dovish central banks, but the data, if it goes their way, would insinuate that they've done the job with rate cuts and maybe they can look to pause. But the situation, again, is very much like the Bank of Japan, in that if we didn't have all this tariff trade mess going on, then perhaps their monetary policy decision might be probably would be a lot different to what's going to be expected this week. And in that case, they'll be looking maybe at a pause without all this mess. So again, we have to think about what happens if there's a fairly quick resolution in trade talks with the US, and if we've got a market that's perhaps maybe a bit too dovish than it should be over the ECB. Now, if we get hotter CPI numbers and worse GDP numbers, that will put the ECB in a bit of a bind, because they'll be facing the old stagflation risk there. Now, the central bank trade may be well down the importance ladder on the trading front, but we always need to keep our finger on the macro pulse, and so we know how to judge how assets might reprice if the geopolitical input is removed. Now, as I mentioned several times, euro dollar isn't trading up near 115 because everything's rosy and hunky-dory in the Eurozone. So this week's data is going to be key to get that snapshot of the fundamentals, to keep at the back of your mind, to take forward if we get a resolution in this trade stuff. Now, for the euro dollar, I said last week we were trading up when we were recording up at 115. I said if we couldn't hold that, then I'd expect to dip to 114, maybe even 113. 115 failed. I wasn't expecting to see 113 pretty much a couple of hours later, but that's what happened. And right now, I think the market is in full-on what next mode. As I said, it's trading between these headlines. It's got a bit of lethargy over all these headlines coming out. We're sitting pretty much between 113 and 114. That's inside a bigger range. I'm watching 112, 115. So really take your cues from what happens during this week and whether we can test or even break that wide up range 112, 115.
Yes, absolutely. I would fully agree with you in terms of that range for the common currency. That's going to be very, very important indeed. Although, as I said last week, now I've actually had my lunch and that bet has been settled. The euro can frankly go wherever the hell it wants. Away from the Eurozone this week, I think the other release that's going to be really interesting is the GDP figures, the Q1 GDP number out of the United States, because to be completely honest with you, that could end up wherever the hell it wants as well. Such is the dispersion around expectations for the data. Just to give you an idea, consensus sees the US economy having grown by a modest 0.4% on an annualized quarter-on-quarter basis in Q1. The majority of the drag is going to come as a result of a surge in imports. Basically, anyone who's importing in the United States has sat there in the first quarter and gone, well, Trump is going to impose tariffs at some point. I will therefore try and front run those measures and get my imports into the country before those tariffs go into effect. Of course, the greater your imports, or I should say, technically speaking, the lower your net exports, the weaker your GDP number is going to be. While consensus sees the economy growing by 0.4%, what I think is more interesting is the forecast that we've actually got from various regional Federal Reserve banks, because they put together these nowcasts or GDP now models, which are basically incorporating data as it's released. And they're supposedly putting it into a very complicated statistical model that comes up with a number. But I think your gesticulation may be more correct, because the Atlanta Fed, who have been very, very accurate for the entire cycle, when they adjust for the imports of gold that have been skewing the data, they see the economy shrinking by 0.4% in the first quarter. However, the New York Fed, who have also been relatively accurate, they see the economy growing by 2.6% in the first 3 months of the year. Now, I mean, you could park a double-decker bus in that spread, to be completely honest with you. But again, at least for the intraday traders out there, that could provide a little bit of volatility to get your teeth into as that data drops on Wednesday afternoon.
Yeah, I think it's going to be one of those known unknowns. We saw the opposite happening in China, where their exports have been booming. So, I don't know with the Atlanta Fed or whoever's adjusting for the gold, because if the gold imports are stopped, but the rest of the trade imports have grown, then the net it's the same issue. But I'm not here to get stuck into the minutiae of that rubbish. Suffice to say, it's going to be what it's going to be. If it's bad news, the market is going to react, whether it's import-led or not. But again, we've been having this conversation. We're still seeing private survey data, sentiment data, all showing negatives. But even last week, we had some hard data, particularly in the housing market, and no real worries there at all. So we've still got this disparity between what we're seeing in some of the data points and versus the hard data. And until that starts to change, the market's just going to brush it off.
Indeed. That's a shame. That I would happily sit here and discuss the minutiae of GDP, but that would probably talk. Well, all our viewers are about to do that as well. So instead, let's get on to our place of the day. Not going to talk about GDP, don't worry. I am going to talk about gold, though, having just said that, but how to trade gold. We did see the yellow metal lose its shine a little bit last week. We traded. We traded as high as $3,500 an ounce. There we go. That's well deserved, I think. Where was I? Yes, $3,500 an ounce. We traded to fresh record highs at that level last Tuesday. Gold very much enjoying its salad days, but then coming off the boil a little bit. Profits being taken at that big figure. Of course, long gold has been a very, very crowded trade indeed. So it's perhaps no surprise to see some of that momentum unwind. But personally, I still see quite a lot to like about bullion at this moment in time. And given the political uncertainty and instability in the United States, I think this is really perhaps the only effective hedge in the current environment. Certainly wouldn't be rushing into treasuries or rushing into the dollar anytime soon. As a result of that, I think this area between $3,200 and $3,300 an ounce looks to be a pretty decent one in terms of buying gold on weakness. And actually from a much longer time horizon, all the time we're above the 50-day moving average, which isn't until the mid 3000s, then I would still be happy to like gold higher, but of course, as I said, very, very crowded, so we could see some more of that momentum unwind. But this is for now a dip that I would be looking to buy. Ryan, we are going down under with you.
Yeah, but before we do that, we can't have you running too long without having a market bet to have some interest in. So
who do I owe lunch to now?
Oh, let's have a quick one. If we're meeting up on Friday, then let's have a couple of pints on it. Gold. 3.5 or 3.7? What comes? Sorry, 3.2. Sorry, let's start that again. 3,000 or 3,500? What comes first?
Right, now you've got that the terms right. 3.5 will come first.
Okay, I'll take the other side of that. I'll go for 3K. And
that's got to be settled by Friday. That might be the toughest ask of the lot there.
Well, if it doesn't happen, we'll roll it over.
Right, well, let's roll over into the Aussie.
Yeah, let's get talking about the Aussie. A quick one for me. I'm looking for a bit of a break trade. This is something that we've been looking in our chat room as well. A lot of people looking for a bit of bullishness from this Aussie dollar. So I'm looking for a break above the 64.40 level. It's been a bit of an old level. We hit it on the way down. As you can see there, it's a bit of a fib level on the way back up. So it really is a deciding level for me. So I'm going with a couple of buy stops just above it. What I would say is, though, this might be on the clock a bit because we've been trying to get this break for quite a long time now. So if it drags on, we might see a few longs getting a bit twitchy and looking to head to the exit doors. Obviously, a couple of risks to look out for. The Aussie elections this weekend pose some risks, as do the RBA, who are largely expected to cut next month. So, or this month rather. So, yeah, a couple of things to keep an eye on.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Very much looking forward to a beer in the sun with you on Friday, and keeping my fingers crossed that you're paying for them now after that little bet. Thank you very much, as always, to our producer, Raf. Kyriakos will presumably be back next week if he decides to grace us with his presence, but who needs him anyway with Raf around. In the meantime, thank you very much as always for watching. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and how you're navigating all of the uncertainty that is out there at the moment. And myself and Ryan will be back with another episode of The Trade-Off this time next week to try and make sense of everything that has happened. And also look forward to a very busy week next week. We've got decisions from the Fed and the BOE next week to get our teeth into as well. In the meantime, thanks again for watching. Goodbye for now.